Welcome to Debt-Free Dreams, your trusted source for building wealth and achieving financial independence. Today, we're exploring one of the most powerful and lesser-known ways to earn passive income in the crypto world: investing in liquidity pools. Whether you're a crypto newbie or an experienced investor, understanding liquidity pools can help you earn rewards while supporting decentralized finance ecosystems. Stick around, and I'll walk you through how they work, the risks involved, and the best platforms to get started. Plus, I'll share tools that make tracking your earnings and managing taxes a breeze. Look in the description below for links to them. Part 2. What are liquidity pools? Let's start with the basics. Definition: a liquidity pool is a smart contract that holds tokens locked by users, providing liquidity for decentralized exchanges and other DeFi applications. Think of it as a shared pot of money that traders use to swap cryptocurrencies without needing a centralized authority. Why they matter? Liquidity pools power decentralized exchanges like Uniswap and PancakeSwap. They make it possible to trade cryptocurrencies 24/7 with low slippage and fast transaction times. Rewards for liquidity providers: in return for locking up your tokens, you earn a share of the transaction fees and sometimes additional rewards in the form of tokens. Part 3. How liquidity pools work. Here's a simplified breakdown. 1. Deposit to tokens. To join a pool, you'll need to deposit to assets in equal value, such as ETH and USDC. These assets are paired, and your contribution becomes part of the pool. 2. Earn fees. Every time a trade occurs using the liquidity pool, a small transaction fee is collected and distributed to liquidity providers based on their share of the pool. 3. LP tokens. When you deposit tokens, you receive LP liquidity provider tokens, which represent your share of the pool. Part 4. Popular platforms for liquidity pools. Here are some of the best platforms for investing in liquidity pools. 1. Uniswap, a leading decentralized exchange on Ethereum. Ideal for major token pairs like ETH, USDC. 2. PancakeSwap, built on Binance Smart Chain, offering low fees and diverse token options. 3. Curve Finance specializes in stablecoin liquidity pools, minimizing impermanent loss. 4. Balancer allows customizable pools with multiple tokens and dynamic weights. Part 5. For risks of investing in liquidity pools. Liquidity pools can be rewarding, but they come with risks. 1. Impermanent loss. When the price of one token in the pool changes significantly, you might earn less than simply holding the tokens. Mitigation tip: choose stablecoin pairs or use tools like TradingView to monitor price trends. 2. Smart contract risks. Vulnerabilities in the pool's code can lead to losses. Mitigation tip: use reputable platforms like Uniswap or Curve with audited smart contracts. 3. Market volatility. Sudden drops in token prices can reduce the value of your investment. 4. High gas fees. On Ethereum, gas fees can eat into your profits. Consider alternatives like Binance Smart Chain or Layer 2 solutions. Part 6. How to get started with liquidity pools. 1. Choose a platform. Research and select a platform based on your risk tolerance and token preferences. 2. Prepare your wallet. Use a secure crypto wallet like SafePool or Alipol to manage your funds. 3. Select a token pair. Look for pairs with high trading volume and low volatility. 4. Deposit funds. Add equal amounts of both tokens to the pool. 5. Monitor your investment. Track your rewards and impermanent loss using tools like Glassnode and CoinStats. Part 7. Tax and earnings management. Earning rewards from liquidity pools can complicate your taxes. Here's how to simplify it. 1. Track transactions. Use tools like Coinly or Zenledger to monitor your earnings and calculate taxable events. 2. Understand tax implications. In most jurisdictions, rewards from liquidity pools are considered taxable income. 3. Stay organized. Regularly export and review your transaction history using platforms like CoinStats. Part 8. Advanced tips for liquidity pool investors. 1. Research new pools. Platforms like EarnDrop can help you discover high-yield pools and new opportunities. 2. Use analytics tools. Leverage tools like Glassnode to analyze on-chain metrics and identify trends in liquidity. 3. Diversify your investment. Don't lock all your funds in a single pool. Spread your risk across multiple platforms and token pairs. 3. Compound your rewards. Reinvest your earnings in additional pools to maximize long-term growth. Now that you know how liquidity pools work and how to invest, it's time to take action. Start by exploring platforms like Uniswap, PancakeSwap, and Curve, and use tools like TradingView and CoinStats to stay ahead of the game. If you found this guide helpful, don't forget to look in the description below for links to the tools I mentioned. Please like, subscribe, and hit the notification bell for more tips on mastering crypto, investing, and achieving financial freedom. Comment below, are you ready to invest in liquidity pools? Let me know your thoughts.